Hi, my name is Elena Tercero, and I am the owner and founder of Little Light Accounting, a CPA firm based out of Santa Fe, New Mexico. And I came outside to do my Periscope. Hi, Belinda. Nice to see you. I was hoping for you guys to be able to see the sunset that was starting to take place behind me, but I'm not too sure if you're going to be able to. So I will jump in with the information that I have for you regarding partnerships for your business as a way to set up your business. So there's different types of partnerships that you can have. You can have a general partnership where you and the partners, there can be 2 or more partners, and you share equally in the profits, losses, and responsibilities of the partnership. Then there's another one that is a limited liability partnership. So there can be partners that are in the partnership that just want limited liability, and so they are more of investor type partners in your organization or in your business, and they don't do as much of the management piece of it because they want to limit their risk in your business or in the partnership. And then there's also joint ventures where you're working together and they're for a certain period of time. So those are the types of partnerships that are available. And I'll talk a little bit more about the partnerships, then I'll talk about the advantages and then disadvantages of having partners as partnerships. So you're going to want to register with your state, of course, because you're going to have a doing business as a DBA. So you're not going to use your name in the partnership. You're going to come up with something for your business. So you definitely want to make sure that you file with your state a doing business as. You will also need to file with the IRS, so that way and get an employer identification number, because you will need to file partnership tax returns. So that is considered a 1065, just so that way you know the type of return that it is. It is informational only on your revenue and your expenses. You do not pay any taxes with that tax return, but the partners will receive a K1, and that is a copy of the partnership tax return. So depending on what the split is of the partnership, if it's 2 people and it's a 50-50 split, then 50% of the information, 50% of the income and the expenses are going to show up on one partner, and then the other half is going to show up on the other partner's K1, and that information then flows into your personal tax return. So you are taxed at your individual level, your personal tax bracket, as opposed to being taxed as a company or a corporation. So that's definitely an advantage for you. You're not taxed twice. Now, if you are a partner of this partnership, then you are not an employee. You do not receive a W-2. So Susanna, you're asking how does a husband and wife set up so that way you both earn? For tax purposes with the IRS, they consider you one and the same, a husband and wife. So you don't necessarily have to set up a partnership because you are already married. So you can keep it as a sole proprietorship and do a doing business as, or you can set up a limited liability corporation. It's still taxed at your individual tax bracket, or depending on the type of business you want to set up and that structure that you want. I talked about in a previous Periscope actually about the sole proprietors. So if you want to learn more about that, you can check out my Periscope on catch.me, katch.me/Elena Tercero, and hopefully that'll help you answer the question of whether you want to stay as a sole proprietor or if you want to move into. I'll talk in my next Periscope about LLCs and whether or not you want to do something like that. You don't necessarily need to set up a partnership, though, for you and your husband. So The partners are not employees. They do not receive W-2s. They do receive their K-1, and usually, depending on if you did have income left over, or revenue was greater than your expenses for that partnership, you had extra money and you're going to distribute those earnings to the partnership, then it's a distribution and it's not income. So that's taxed a little bit differently as well for partnerships. So the advantages for partnerships, they're easy to set up. You're just going to register with your state and register for an employee identification number with the IRS. That's pretty much it. I'll talk about the disadvantages and one other thing that I highly, highly recommend you do if you do set up a partnership with somebody else. And employee, you can also have employee incentives as an advantage, because if you have employees that are working with your company, as an incentive, you can incentivize partnership into your company with to your employees. So that can be an incentive for your employees to work towards becoming a partner in your business. Now, some of the disadvantages. So one disadvantage is you are jointly and individually liable for what happens in the business, both debt-wise and any other liability that may happen, employee liability. So you really want to make sure that you have the insurance, business insurance, business liability insurance, and then you also have workers' comp insurance if you have employees within your partnership. Now, I had talked about, as a side note for partnerships, my husband and I had a partnership with some friends of ours, and it was a very good working partnership for us, between the four of us, because it was me, my husband, his friend, and then the husband's wife. So there were four of us in this partnership. We knew that we were going to do everything 50-50. We worked really well together. We built a home and then we sold it. Then the house got sold to somebody else, and then the house got sold to somebody else. This third person that owned the home flooded. There was a really bad rain that had taken place, and the home flooded. So they came back to the builders, which was us, and they actually sued both the company that was established. It was a partnership. They sued us individually. They sued the homeowners association that the house was in, the subcontractors that we had used on this home. They just brought in anybody and everybody that they could. But they could do that because we were set up as a partnership. We didn't have personal liability. We had personal liability in this home. Now, the really sad thing is that what was causing the flood was not our fault. We had left the yard completely unenclosed, and the owners, two owners down, enclosed the backyard. And then that's what caused the flooding. So it was no fault of our own. We had the house properly drained. You know, the drain was properly flowing, but the owners that owned the house didn't know that. So we had to go through the process. And so one thing that can really be hard about partnerships is that legal liability for you, and the fact that they can come after you as an individual. So do keep that in mind. We do have actual, it happened to us. So do be careful with that. Another disadvantage is disagreements among the partners in the partnership. Hi, how are you? Glad that you joined us. So another disadvantage, if you don't know how to communicate with each other, that's going to mess up your business and the partnership. You don't want that to happen. So I highly recommend that if partnership route is the way that you're going to go, that you have a legal document that talks about what you are going to do for the name. Yes, I did. Blue Sage, I did see the picture that was on Twitter. Thank you so much. So legal partnership agreement, you have to have it if you're going to have a partnership. Out of all of the types of business ownership, this is the one that I do not like at all. Personally, if you're going to go into business, I do not recommend partnerships. They are so hard, especially a family, if you're friends, and even if you're not, you just don't. You have to have everything documented, and even with that, sometimes things can happen. So you want to have the name of the partnership in this legal document. You want to know the contributions, how that's going to happen in the partnership, in the document. You also want to know how you're going to distribute the profit and loss. Most of the time it's 50-50, but not always. And so you need that documented. You also need to have documented how you're going to be compensated as a partnership. So when, how, all the basics of management duties, you need to have all of that written out. If you do get into a disagreement, what will happen and how do you get past that disagreement? There's only two. It's hard. If there's, no matter how many there are, how many partners there are, it can be very hard when disagreements happen. So you need to make sure that that is documented. The other thing that you want to document as well is if say I am in a partnership, and I am in a partnership with somebody else, another CPA. Well, the two of us, my husband is not a part of this partnership. So what's going to happen if something happens to me? Say a former coworker always used to tell me, well, what happens if I get hit by a train? You need to have all this information. So what if I get hit by a train? What is going to happen to that partnership? What happens to my husband because he had ownership in that partnership, even though he doesn't because he wasn't a partner? So you need to make sure even things like that, worst case scenarios, need to be documented in this partnership, so that way there are no questions left unanswered. It really protects both partners, or however many partners there are. There's nothing left to question. There's nothing left to chance. And even as time goes on and you realize that there might be something else that you've forgotten, well, that's okay. You go in and amend it's kind of like a contract. You amend the agreement with each other. So that way you have everything documented. Another disadvantage or potential disadvantage is that you're sharing profits with your partner. So if you really intend for that business, for you to own that business and for you to be able to bring in all of the profits of that business, well, you're now sharing it with somebody else. So that could be a disadvantage, doesn't necessarily have to be, but it is there. You are now sharing with somebody else. So make sure, this really is all about partnerships today. I really do hope that you found value in all of this. My name again is Elena Tercero. I am the owner and founder of Little Light Accounting, a CPA firm based in Santa Fe, New Mexico. And I do also have a website, so that way you can put in your email address and receive a free PDF with some more tax tips. So you can go to bit.ly/LLA tax tips, and you can receive that free PDF with some more tax tips for you. I will be back again to talk more about limited liability corporations. Somebody had asked earlier about a husband and wife and how do they set up their business. And so I will talk about an LLC as one way to be able to do that. And then I'll just keep going on through the different types of business types that you can set up. So I really do hope that you found value in this. If you are watching on the rebroadcast, You're very welcome, Susanna. If you are watching this on the rebroadcast, you still can share with your followers and your friends. So please do share if you find value in this. And also those of you that are on live, please do share. And I look forward to seeing you next time.